If you're a millennial, you've probably heard people say, there's no way you can afford to buy a home in this economy. But is that actually true? The reality is most people never find out because they make one big mistake, and that is they self-disqualify. They listen to headlines about unaffordable housing, or they tell themselves things like, I need to pay off my student loans, or I probably don't have enough money saved. But the truth is, a 15-minute conversation with a lender could completely change what you think is possible and put you on a path to home ownership sooner. So in this video, we're going to talk about home prices, down payments, debt, and credit, and what you really need to know before you decide to buy a home. But first, why is this even important to own a home? For many millennials, buying a home is about more than just having a place to live. And I wouldn't say this is just about millennials. This is just about people in our country. So many of them want to buy a home because we know that is how we build wealth in our country. The average statistic, and I've said this before, I'm going to say it again, for a renter is roughly $10,000 in net wealth compared to $400,000 for a homeowner. Now again, depending on how long you've owned a home and how many homes you've purchased, and that equity just keeps rolling over and building over time, but that's really just a big piece of the home ownership goal. And we're going to chunk down all the other things that go along with home ownership, but really important just to kind of take a step back and say, if you're renting, no matter what mortgage rates are, you're paying 100% interest. Think of it that way, because in reality, you have nothing from that renting relationship. No ownership, no appreciation, no control, etc. Now, for some people, that's exciting because they want to be able to move every year. They want to be able to get up and go. They don't want the hassle of home ownership. And home ownership does require responsibility. It does require some of that stuff. But the upside in a true just comparison between renters over a lifetime and home ownership over a lifetime, it truly is materially different when we think about how we build wealth in our country. So when you rent, your monthly payment goes to your landlord and you walk away with nothing to show for it. But when you own a home, every payment you make is helping you build that equity in an asset that historically grows in value over time. That's because homeowners benefit both from paying down that mortgage, so a portion of that payment goes towards your principal, and the potential home appreciation. Over time, that combination can create substantial wealth, something that rent just doesn't do. For many millennials thinking about future financing, homeownership is one of the most powerful ways to start building long-term wealth instead of just paying for someone else's investment. All right, home prices. Yes, they do increase over time. That's where that appreciation comes from. Is it every year, year over year? No. Certainly we had a moment in time in our history in that kind of 2008 to 2013 timeframe. There were things that led up to that Great Recession, as we call it. But outside of that blip, historically over time, home values increase year over year. Now, there's a lot of detail that goes around this. And I don't want to be one of those people that just like, oh, your house is always going to appreciate by 2% or 5% or 10%, because that's just not real. So much of the appreciation is going to come down to where the home is. What's the specifics of that neighborhood? What's the supply and demand? Because supply and demand is a big component to home appreciation. So if you're buying in an area that just doesn't have a lot of demand, it's very likely that your appreciation is going to be slower or at a lower amount versus buying in an area that has high demand. But again, if you're gonna buy in an area that has high demand, it's probably gonna cost you more. So it's just supply and demand really does work when we think about home prices. But maybe you're just like, hey, I'm a first-time home buyer and I really want to buy a home, but I can't buy it maybe, in the city, if you will. Drive if you can. So in this area, with areas across the country, so much of that new home construction is being built kind of like on the outer skirts of what is maybe the metropolitan areas. And if you're willing to drive 30, 45 minutes to jobs, daycare, work, whatever that looks like, if that can work for you, that is a great option, because these new home builders, this new home construction, oh my goodness, they are offering such incredible historic incentives that can really allow you to get into that house at current prices under market, meaning under market rate. So in comparison, these builders right now, through their mortgage partnerships, are able to offer lower interest rates when compared to just what average interest rates are. And that could be 2 to 3% lower. So if we think that average interest rates currently are, let's call it 6%, in some of these situations, we're seeing builders offer 3.99%, 4.99%. That is a material difference to your payment and can create affordability. So if you're in a situation where you can drive, that works for your lifestyle, and maybe you don't even have to drive, maybe your employer is located in an area that there is new construction close by, then awesome. But think about just what's the drive look like, and can this allow you to enter into a home and the price point you want to be at a payment that is comfortable for you. The other thing, as a millennial, maybe consider a roommate. We kind of call this house hacking. If you are specifically single, or maybe no children yet, it's a little bit easier to do this, and you have a roommate and you're going to rent out that room. That rental income can help offset your monthly expense. So just another way that you can think about how to buy a home without just being blown away with the current payment of housing prices and interest rates. Debt. Oh my goodness. It is just so important, especially car payments. This is like the big thing because cars are more expensive. Interest rates are higher. So when people are buying cars, they don't really realize the impact to the total debt to income ratio, which is going to drive your home loan approval. This is a real story. I'm not making this up. So a team member in my office and a good friend, known her for many years, and she wanted to buy a house. She also wanted to buy a new car. Now she had a amazing car. It was a fancy Escalade with all the gadgets, and that thing was coming up for a renewal on her lease. And she's like, at this point, she still does not own a house. And she's like, oh, here's the payment on the new Escalade. And I said, okay, well, just realize, let's do some math. Here's the income, here's the spouse's income, here's the other debts, here's the payment on that Escalade. That Escalade payment is going to directly impact and cost you X dollars on that home purchase, meaning in your purchase price. So either you buy the Escalade and not buy a house, because in reality, she couldn't find a house that she wanted to in that price point with that Escalade payment. Once we re-looked at it, she ended up not buying an Escalade. Payment on that new car came down dramatically, and guess what? She bought her first home and got a killer deal on it, bought new construction, and she is just so excited and happy. But just to be able to walk through how some of these debt payments impact that overall qualifying ratio and the trade-off. If you want that fancy Escalade, you may have to give up something on price if you are in the market to purchase a home. So be sure to talk with a lender before you buy the car. Before, not after, before. And have them run you through that same type of exercise, because for her, she's like, wow, the light bulb just went off. And it was a great moment. I always get excited about that stuff, but it was a great moment to see the light bulb go off with her and make the decision that I want to be a homeowner, and that's more important than the Escalade. So help me figure out how to do that. And we did just that. Down payment. It surprises me that so many people today still believe that you need to put 20% down on a home when you purchase it. And that's just not the case. The reality is, depending on the loan program, that's going to dictate and drive the down payment. But if you have served in the military, the National Guard, or the reserves, and you have VA home loan benefits, that could offer you a 0 down payment in some cases. If you are just somebody that really wants to buy a house and everything comes together, maybe you just don't have the funds to do that from a down payment and closing cost standpoint, there are down payment assistant programs out there that could help you buy a home if that's the one thing that's holding you back. You can do as low as 3% down on a traditional conforming conventional loan. You can do 5% down, 10% down, 15% down, 20% down, or more. So the down payment percentage, don't let that hold you back. Again, get into the conversation with a lender who can run through your specifics, how much money you have. Also keep in mind that if you're putting down less than 20%, which is where I think this whole kind of you need 20% to put down comes from, you will have to pay mortgage insurance other than on a VA home loan. What is mortgage insurance? Mortgage insurance is essentially insurance for the lender because you are putting less money down, so less skin in the game. And so it's insurance for the lender in case you default. That's truly what it is. And it gets a bad rap. So many people are like, oh, mortgage insurance is the enemy. Well, in reality, very few people can come up with 20% down to purchase a home. And if we're going to advocate for home ownership, we have to be creative and think about how people can buy a home with that first stepping stone. And yes, maybe that means you're paying mortgage insurance for a period of time, but as you pay down that principal, as the home appreciates, or maybe it's not on this house, but it's the next house, you can position to keep rolling that equity over and put it as a down payment on the next house. So the goal is to get you out of mortgage insurance, and that's one way to do it. But also, from a mortgage insurance standpoint, depending on the loan type, again, it's going to vary between FHA and conventional, but on conventional, that mortgage insurance is automatically going to drop off at some point in the life of the loan. Doesn't work that way on FHA. We can get into that at another time. But mortgage insurance is not the enemy. That is what is key here. And you can, absolutely can, as long as your debt to income ratio and all the other things required for the home loan approval process fall into line, you can purchase a home with less than 20% down today. Let's talk about credit cards. Credit cards are the one thing that can drop your credit score or improve your credit score. So here's the strategy. Here's the secret. There's a point in time, so when the lender pulls your credit, the balance to your limit at that point in time is going to directly impact your credit score. Let's talk that through. Let's say you have a $10,000 limit on your credit card, and even if you pay that credit card off monthly, if at the point in time that the lender is pulling your credit, maybe it's maxed out, or maybe it's got an $8,000 balance on a $10,000 limit, and that usage ratio, in that example, you would be at an 80 or 100% borrowing ratio, which is going to drop your credit score. So as you are preparing to think about purchasing a home, this is also why you want to go through the pre-qualification process, have a lender take a peek at your credit, and consult on what does it need to be? What's your credit score today with those balances? Do you pay them off monthly? Talk to a lender before they pull your credit, and they can tell you at what point to pay that off and then align that with when they're going to pull credit. So there's a lot of different strategy there. But when it comes to credit cards, here is the one thing. All right, this is the second thing you need to know, and that is 1 30-day late payment on a credit card can drop your score dramatically, 80, 100 points. It's crazy, but it's true. So think about what you can do to set up in your phone a reminder, etc., to ensure that that payment gets made. Now, I do realize that life happens, and sometimes financially you just can't make it. That's not what I'm talking about. But the people I talk to, they have great credit sometimes, or maybe they've been on a credit plan and they've really been working on their credit and they're cruising along and that credit score is coming up, and then they just go on vacation and they miss it. Only because, not because they didn't have the money, but because they just missed the date. So be sure to set up a system in your life that you can make sure that that late payment does not hit, because that 1 30-day late payment on a credit card is going to have a trickle-down effect and impact a lot. Not only just the home loan process, but certainly credit score, etc. So build that into your monthly budget and your process. What's the ideal balance to limit ratio? Let's talk about that. Ideally, based on all of the feedback that we get, and we have all kinds of different simulators and credit education from the credit agencies, etc., the sweet spot is keeping your balance at 20% or lower of the limit. Now, that is varied over the years. Sometimes it's 30%, sometimes it's 20%. But the bottom line is try to keep that balance on the credit card at, I'm going to call it 30% or lower of the limit. You also want to use the credit card. So a lot of times people will say, hey, I'm going to buy a house and I'm going to pay off all my debt and I'm going to close that credit card. Sometimes that can dramatically drop your credit score. So yes, pay it off. That's awesome. But you want to then have usage on it, because after 6 months, it will become dormant and then it's going to be less impactful to your overall credit score. And that actually may be helping your credit score. So if you pay your credit card off, go to dinner, charge the $50 or whatever it is, and then pay it off. Just trying to keep that usage on the account every 6 months is also an important tip. The biggest mistake I see millennials make when it comes to buying a home is deciding that they can't afford it before they ever talk to a lender. The truth is, every situation is different. Down payment options, credit guidelines, and debt to income ratios are very often just different than what people assume. So what you think might take years to accomplish could actually be much closer than you realize. So before you talk yourself out of home ownership, take the next step. Have a conversation with a professional who can actually look at your numbers, your scenario, and help you get to your goal. If you're curious about what that might look like, I encourage you to call, text, or schedule a call with a Kelly ZITLOW Group mortgage advisor. We can walk you through your options, help you create a game plan, and get you on the path to home ownership.